Hi everybody and welcome to the Luco Show. If you haven't already, please subscribe. Today we're going to be looking at something really cool that I've just come across. So in this book, the go-to book for any beginner in investing or economics or anything like that, The Intelligent Investor by Benjamin Graham, the father of value investing, Warren Buffett's mentor. In this book, first published in 1949, Graham tells you that it's a good idea, or at least he tells you that it's a shrewd investment to invest in cryptocurrencies, specifically in small to medium sized market cap altcoins. So there's a bombshell, and I've looked all across YouTube, all across the internet. No one has put this connection together yet, so stay tuned and you'll find out exactly why. So yeah, an interesting revelation we've discovered here today. There were no questions really underneath the last video, so we're going to skip the Q&A session today and just get straight into reading effectively. So yeah, the intelligent investor. There are three main concepts discussed in this book. Firstly, the difference between investing, pure investing, and speculative trading. Graham was largely against the idea of speculation, i.e. whenever you only buy an asset or you buy something because you think that it's going to go up in value. He preferred and encouraged the more investment-based approach, whereby you would purchase shares in a business because you liked that business, you thought that it was going to flourish and grow over time. So it was much more of a fundamental investment type approach, as opposed to just buying something to try and sell it to, the greater fool theory, to try and sell to someone else at a higher price. Eventually, obviously, if everyone engages in that pyramid scheme approach to speculation, it'll obviously unravel afterwards. So that's why he was always more strict in his approach and his advice to always adopt this intelligent investor type of approach as opposed to speculation. Secondly, the second main concept in the book is the idea of having a contrarian view to the average person, or Mr. Market as he referred to it as in the book. So effectively, if 99% of people are doing one thing, realistically the person who's doing the other thing or seeing something that they're not noticing might be the thing that you should be doing, and the thing that will be rewarded in the long term. And lastly, and that's what we're going to touch on today, the third main concept discussed in the book is the importance of maintaining an appropriate margin of safety when investing. So that is effectively the idea that, say I wanted to buy shares in Tennis Ball PLC, if they were overvalued, if those shares were overvalued, even though I like the company, if I believe that they were dear whenever I wanted to invest in them, there would be no margin of safety there. If, however, I believed that it was really cheap and it was undervalued, that stock or that share at the time, the fact that my due diligence suggested that it was undervalued, that would create a margin of safety, thereby making it, in Graham's criterion, a shrewd investment. So the differences in pure investing and speculative trading, the benefits of having a contrarian view to the market as a whole, and the importance of maintaining an appropriate margin of safety. They're the three main takeaways from this book in The Intelligent Investor. I think it's the Swedish investor. There's a different YouTube channel who does like 10-minute book summaries. I'm not sure exactly who has done it on this book, but I'll find it and I'll put a link in the description below to the channel that did a really good 10-minute summary on the book. But we're going to specifically look at one quick, it's only going to take 2 minutes, passage in it's chapter 20, margin of safety as the central concept of investment, and subsection extension of the concept of investment. And here Benjamin Graham, who died in like 1976, told us that it was a good idea to invest in cryptocurrency in 2020. So you'll soon see why. Okay. Unconventional investments are those that are suitable for only the enterprising investor. They cover a wide range. The broadest category is that of undervalued common stocks, of secondary companies, which we recommend for purchase when these can be bought at 2/3 or less of their indicated value. Besides these, there is often a wide choice of medium grade corporate bonds and preferred stocks when they are selling at such depressed prices as to be obtainable, also at a considerable discount from their apparent value. In these cases, the average investor would be inclined to call the securities speculative because in his mind, their lack of a first quality rating is synonymous with a lack of investment merit. It is our argument that a sufficiently low price can turn a security of mediocre quality into a sound investment opportunity, provided that the buyer is informed and experienced and that he practices adequate diversification. For if the price is low enough to create a substantial margin of safety, as in like the price of the share or whatever has dropped enough to create a substantial margin of safety, the security thereby meets our criterion of investment. Our favourite supporting illustration is taken from the field of real estate bonds. In the 1920s, so here's a specific example here. In the 1920s, billions of dollars worth of these issues were sold at par and widely recommended as sound investments. A large proportion had so little margin of value over debt as to in fact be highly speculative in character. In the Depression of the 1930s, an erroneous quantity of these bonds defaulted in their interest and their price collapsed, in some cases below 10 cents on the dollar. So these real estate bonds in the 1920s, after the crash of 1929, at the beginning of the Depression in the early 1930s, some of these real estate bonds had fallen by over 90% in value. You could still buy them, but they'd fallen by over 90% in value. At that stage, the same advisors who had recommended them at par as safe investments were rejecting them as paper of the most speculative and unattractive type. But as a matter of the fact, the price depreciation of about 90% actually made many of these securities exceedingly attractive and reasonably safe, for the true values behind them were 4 or 5 times the market quotation. So this is interesting, and this is actually the same sort of rhetoric that we're hearing today. It's saying here that financial advisors, effectively, who in the late 1920s were saying that these real estate bonds were a really sound investment, a couple of years later, whenever these same real estate bonds had fallen by 90% plus in value, those same financial advisors were then writing them off, saying, no, they're not worth the paper they're written on. So can you see how that's unusual? If 1 second these financial advisors are saying, oh, buy this, then it falls by 90% and suddenly it's not a good idea. It shows you how people don't factor in this whole idea of margin of safety whenever things fall down by a certain amount. The fact that the purchase of these bonds actually resulted in what is generally called a large speculative profit did not prevent them from having true investment qualities at their low prices. The speculative profit was the purchaser's reward for having made an unusually shrewd investment. They could properly be called investment opportunities, since a careful analysis would have shown that the excess of value over price provided a large margin of safety. Thus, the very class of fair weather investments, which we stated above, is a chief source of serious loss to naive security buyers, and it is likely to afford many sound profit opportunities to the sophisticated operator who may buy them later at pretty much his or her own price. So, really, really cool. Effectively, I've written down the note here because Graham now regarded these previously speculative investments as, quote, exceedingly attractive and reasonably safe, as the prices were low enough to create substantial margin of safety, providing that the buyer practices adequate diversification. Okay. You get that by now. Real estate bonds, 1920s, highly speculative investments. People were getting involved, roaring 20s, thinking everything was going to go up forever. Ultimate crash. Now, following the ultimate crash, there are obviously opportunities, and people didn't realize this at the time. Even the financial advisors at the time thought that, oh, these are worthless. But they weren't worthless. and it turned out that they actually increased, if you got in whenever they'd fallen by 90+%, by like 3 or 4 times over the next year or two. How does this compare to cryptocurrency? Okay, I'll be honest, Benjamin Graham doesn't specifically mention cryptocurrency in the book that he wrote in 1949. But when we look at the cryptocurrency markets now, from the all-time highs in December 2017, so 2.5 years ago almost now, if you look at Bitcoin specifically, it was at 20,000 at its all-time high, and it's fallen down to the 3,000 range, got back up to 11,000 or so, and it's now sitting at 7,500. But leaving Bitcoin aside, ignore the larger market cap coins. If you look at the mid caps and the small cap coins, a large number of them are still going. They still have, developers, all sorts of people working on these cryptocurrency projects. However, their value, the price of these altcoins, has fallen by way over 90% in many cases. If I look at 3 in particular, Icon has fallen by over 97% from its all-time high. Quantum has fallen by over 98% from its all-time high. And Electronium has fallen by over 99% from its all-time high. So, that's standard. That's standard across the cryptocurrency market for all medium cap or mid cap and small cap coins, with a few exceptions. So Benjamin Graham always suggested investing, not speculating. But there was one occasion in which speculating actually qualified as a shrewd investment, and that was a scenario in which asset prices had fallen to such extreme extents that it actually qualified as a shrewd investment because the margin of safety was so strong. And it would be only appropriate to get involved with those assets, providing, quote, the buyer practices adequate diversification, meaning that you don't just buy one of them, because in theory one of them can go to zero. But if you buy a portion of them and you spread out over, if you do your own research and due diligence, you look at the use case, you go and look at the websites and the Twitter accounts, and you see that these cryptocurrency projects are still active, they're still going. If you can find a few that you have confidence in, that you think there might be merit to these long term, the prices are so suppressed at the moment that these assets clearly have adequate margin of safety, that they, under Ben Graham's criterion, meet his criterion as a shrewd investment. So I just was reading through the book there and came across that chapter, and I don't know why the link to cryptocurrency popped in my head, but I think that most would agree that the exact same, you can compare real estate bond market from the 1920s to 2020 now and the cryptocurrency altcoin market, which is a really unusual thing to be able to link, but the concept still applies. So whether or not, the cryptocurrency community are constantly arguing among themselves across forums, crypto Twitter and things like this, saying, is the bottom in yet? Are we beginning a new bull run? And no one really knows. So, you can try and time the market, you can try and look for the bottom. Maybe it'll be a few years away, maybe it's today, don't know. But all I know is, under Ben Graham's criterion, it's a shrewd investment. So something to think about anyway. If you enjoy the content from today or any other, please share it, please click subscribe, give any feedback if you have any, positive or negative, happy to have it. And yeah, have a good one.